What exactly are index funds, mutual funds, and ETFs, and what's the difference between them? Well, let's start with the similarities. Index funds, mutual funds, and ETFs, which is short for exchange-traded funds, are professionally managed collections of individual stocks or bonds. Rather than invest in a single company like you would by buying individual stocks, with index funds, mutual funds, and ETFs, you're investing in a tiny sliver of a bunch of different stocks. The specific stocks included are chosen by the fund manager, which is the entity responsible for creating and packaging the fund. Many of the larger brokerages like Vanguard, Fidelity, and Charles Schwab have their own suite of index funds, mutual funds, and ETFs that they provide. You can usually identify these funds by looking at their name, like the Vanguard Total Stock Market Index Fund, which is obviously provided by Vanguard. All three of these fund types, so index funds, mutual funds, and ETFs, can cover a certain category of the market. For example, you might have a fund that's focused on small cap companies. This means that all of the holdings, so all of the individual stocks that make up the fund, all of these holdings will be focused on smaller companies that are experiencing growth, so higher potential returns but might be deemed slightly riskier than larger companies who are more established. Other funds might be focused on specific sectors of the market, like technology or retail or healthcare, where all of the holdings will be companies involved in those industries. Say that you believe that the technology industry would experience huge growth in the coming years, but you don't know exactly which tech company would do well. There are so many tech companies out there, it can be really hard for the average investor to keep track of them all. One company could go bankrupt while 10 others do really well. So if you're investing in individual stocks and choose wrongly, you could be down on your investment despite overall growth in the industry. In this situation, it would make sense to choose a technology-focused index fund, mutual fund, or ETF, because you'd have exposure to a bunch of different tech companies, therefore minimizing your risk. One of the main advantages that index funds, mutual funds, and ETFs all have over investing in individual stocks is just the breadth of diversification that is possible. While index funds, mutual funds, and ETFs are all very similar, there are some subtle but significant differences. Let's first start with mutual funds versus index funds. First, it's important to understand that the term mutual fund simply refers to the fund's structure. It just means that the fund is a collection of individual stocks, which investors have mutually pooled their money together to purchase. Conversely, the term index fund refers to a fund's investment approach. An index fund is simply a fund that tracks a specific stock market index, like the S&P 500, which tracks the performance of 500 large-cap US companies. Index funds aim to match the performance of the index that they are tracking. The term mutual fund and index fund describe two distinct categories: mutual fund for the fund's structure and index fund for the fund's investment approach. So a fund can be both a mutual fund and an index fund at the same time. Most index funds are usually mutual funds too, but not all mutual funds are index funds. When people say mutual fund, they're typically referring to any mutual fund that's not also an index fund. While index funds are considered passively managed because they track a specific stock market index, which can be done easily with a computer, some mutual funds are actually actively managed. This means that rather than follow an index, the fund managers will make trading decisions on the fund's holdings based off of their own professional opinions. An index fund will never outperform the index that it is tracking because, well, that's the whole point of an index fund, is to match the index as closely as possible. But an actively managed mutual fund has the opportunity to beat that same index because humans are making decisions about the fund's holdings. For example, let's say that there are three stocks, stock A, B, and C, which make up the ABC index. Each stock performs differently, but the entire index is up 10% for the year. So if you had an index fund for the ABC index, your investment would also be up 10% for the year. If you had an actively managed mutual fund, however, and the fund manager has the foresight to realize that stock C is going to do poorly that year, but another stock D, might do really well, that fund manager might make the decision to only include stocks A, B, and D in that mutual fund. Because of the human-driven decisions made in the mutual fund, the fund is up 15% for the year, beating the ABC index. Of course, the reverse is absolutely possible, making actively managed mutual funds a little bit less predictable than index funds, which aim to match the returns of the stock market index. The other points to consider here are the fees involved. Because index funds are usually very passive, all trading decisions are made by a computer algorithm to just match the index as closely as possible, The operating and administrative expenses involved are very low. Conversely, mutual funds which are actively managed will have higher fees because there's a team of people involved in making daily trading decisions on the fund's holdings. You're paying a higher price for the expertise of the fund managers and the potential to beat the index instead of just match it. The decision to choose actively managed mutual funds or index funds will ultimately come down to personal preference. But history has shown that index funds tend to do better over time, especially when you consider the higher fees involved in mutual funds. In 2019, index funds outperformed roughly 70% of US actively managed mutual funds, a trend that only goes stronger when you look at it over a longer period of time. So now let's look at how ETFs compare to both mutual and index funds. ETF stands for Exchange Traded Fund, and similar to mutual funds, it refers to a fund's structure. Most, although not all, ETFs track specific stock market indexes, making them also index funds and thus passively managed. Another way of saying this is that index funds can be structured either as a mutual fund or an ETF. The key difference between a mutual fund and an ETF is that mutual funds can only be traded at the end of a stock market day based on a calculated price. An ETF, on the other hand, has more flexibility because it can be traded just like a normal stock at any time when the market is open. Additionally, ETFs are generally considered a little bit more tax efficient because they have a unique way of conducting transactions that aims to reduce the amount of capital gains incurred by the investor. However, if you're investing in a retirement account like a 401k or an IRA, this is really not a factor because you're sheltered from capital gains tax to begin with. This is only really relevant if you're investing in a standard taxable brokerage account. The other key difference between mutual funds and ETFs is that mutual funds often have an investment minimum. This is the minimum investment you must make in order to purchase shares of the fund. After you meet the minimum investment, you can purchase just one share at a time if you want to. Many mutual funds have minimum investments of around a few $1,000s, but ETFs do not. Because ETFs trade like stocks, you can buy one share of them at a time. This makes ETFs a really good option for beginners. When I made my first investment at age 18, I only had a few $100s to spare, so I purchased a few shares of an ETF. Another difference is that mutual funds will typically allow you to set up automatic recurring transactions, while ETFs generally do not. This makes mutual funds a good option if you want to contribute money regularly to an investment account and have it invested automatically without you having to do anything, allowing for a more hands-off investment approach. Finally, the operating expenses of an ETF can be lower than a mutual fund, although I found that this difference is typically negligible when you compare it to a passively managed mutual fund, like one that tracks an index. An actively managed mutual fund will almost always have higher fees than an ETF, but that's primarily due to the fund's investment approach, not the fund structure. There are actively managed ETFs out there, but they're not as common, and people who prefer an actively managed strategy tend to go with mutual funds simply because there are more options. So, to quickly sum up the key similarities and differences between index funds, mutual funds, and ETFs. First, all of these fund types describe professionally managed collections of individual stocks or bonds. Mutual funds and ETFs both describe a fund's structure, while index funds describe a fund's investment approach. Thus, you can have a mutual fund that's also an index fund, just like you can have an ETF that's also an index fund. Index fund simply means a fund that aims to match the performance of a specific index, whether that be the stock market as a whole or certain industries or sectors of the stock market. Both mutual funds and ETFs can be actively managed, which means that fund managers make decisions about the fund's holdings based on their professional opinion, with the goal to outperform the index, not just match it. However, this means that these funds typically have higher fees, and passively managed index funds tend to perform better than actively managed funds over long periods of time anyway. ETFs can be traded like stocks and have no minimum investments, whereas mutual funds can only be traded at the end of the day and typically have a minimum investment required. Additionally, ETFs are generally considered a little bit more tax efficient because they have a unique way of conducting transactions that aims to reduce the amount of capital gains incurred by the investor. However, mutual funds will typically allow you to set up automatic recurring transactions, making them preferable if you prefer a more hands-off approach. I hope you guys learned something from this video. If you did, please consider giving it a thumbs up for the YouTube algorithm. I make videos every week on a range of all sorts of different personal finance topics, so consider subscribing if you want to see more content like this. Thanks for watching, and I will see you all next week.